Welcome, everybody. So today we have all three of us, myself, Tavi, and Quentin. We're all live, and it is August 22nd, and here we are approaching new all-time highs in the stock market once again for the Nasdaq 100 and the S&P 500. Now on hopes of a Fed rate cut coming up in September. Jerome Powell kind of caved in basically today, and got his somewhat the Fed can still change their mind based on the data, but he's definitely signaling that the Fed is leaning more towards the slowing economic data and high as opposed to the higher inflation. They face risks on both sides of things, but there's pressure to cut rates, and it looks like that's the direction we're heading in. Normally, when we have rate cuts, it signals that there is economic slowing, economic weakening, and that's what they're favoring now. But what's the problem? We are still at record all-time high valuations in the stock market. I know we've talked about this for the last several years already, because we've been at high valuations for a long time, and they've only gotten higher. But it is a risk. And this chart here is just showing a variety of U.S. stock market indices, and in particular, the Nasdaq 100 and the S&P 500 are the ones that have 95th percentile range valuations on the next 12 months forward-looking PE ratios. So forward-looking PEs, which have pretty high earnings estimates, by the way, are in high margins, and assuming continued growth in earnings is what's all baked into the forward estimates right now. We're record valuations. Let's not as bad in the Russell 2000 and the equal weight S&P and the mid cap. So it is a concentrated large cap, overvalued market. That's important to understand. But let's go on to the next. This is similar to a chart that I have shown that is focusing on valuations relative to GDP. When we focus on valuations relative to personal income, it's a similar kind of a measure, but it really shows the extent compared to the 2000 tech bubble, which was also a large cap stock market bubble. It really shows how much more extreme this the valuations are today, compared to looking at it in a PE sort of way, or price to book. It really illustrates that we are even more overvalued than that 2000 tech bubble peak, and that 2021 peak as well. Let's keep going. Here now we can look at valuations in the U.S. Compared to the rest of the world, and you can see that we're above the 90th percentile in U.S. valuations. When you look at using the MSCI indices, but look at compared to these other countries, whether it's Japan, the Europe, the emerging markets, the United Kingdom, the world markets ex-US. The U.S. markets are at record valuations, not only relative to themselves and relative to other countries. So important to understand. Let's keep going. Price to book, just another way of looking at valuations. Price to book values at record highs today, higher than the 2000 tech bubble. Let's keep going. This is a nice chart because it goes back to before 1929, and you can see that looking at the top 10% largest U.S. stocks, by year, going back to the 1920s, and the market cap. Again, this is showing the top heaviness in market cap of the stock market indices at large, and you can see that the market cap concentration of the largest stocks, representing the largest percentage of all U.S. stocks going back to 1929 at the highest levels ever, and higher than 2000, higher than 1929. Just another you know indicator that we are at record valuations and a record, I would say, record risk of stock market correction because of valuations. Let's keep going. This is from David Rosenberg, just showing that margin debt in the U.S. in customer securities margin accounts is at an all-time high. And these are, of course, margin debt comes down as you're going into a big correction, and people are selling stocks and getting margin calls. But it's another illustration of the risk at record all-time highs and record valuations for that we're also a record margin debt. Let's keep going. So I've shown this chart a few weeks ago, maybe a month ago, I forget, but we've updated it with the recent month's performance, and what it's showing is the Crescat Global Macro Fund, which has a track record going back to January of 2006, so pre-global financial crisis. And what the downside capture ratio that we're showing here in this chart illustrates is that when you have if your fund has positive returns in down markets, just looking at months when the benchmark was down, and you have a negative downside capture ratio, that means you're going up. Your fund has gone up on average in down markets. And that's the meaning of a negative downside capture ratio. So the Global Macro Fund has a negative downside capture ratio going back to 2006 when it was launched. And so that's pre-global financial crisis. This is a fund that has been through the global financial crisis, and it's still around today. We have positive returns earlier this year in February and in March when the U.S. stock market went down. We're a global macro fund that's not afraid to have short positions on, and we've been able to capitalize on that. So, as an example, what these numbers mean. For example, a downside capture ratio of minus 41.8% versus the S&P 500. That means when the S&P 500 fell 10% on average, our fund gained 4.2% on average. Similarly, a downside capture ratio of minus 84.4% versus the HFRX Global Hedge Fund Index shows that our fund on average since inception going back to 2006 has gained 8.4% when that index has fallen 10% on average. While past performance is not a guarantee of future returns, with the U.S. stock market at record valuations and at risk of a major correction, we think investors should be on the lookout for funds with a proven track record of delivering positive returns in down markets, i.e. a negative downside capture ratio. Let's keep going. So now we're looking at all discretionary global macro hedge funds. According to the eVestment database, that have been around since at least January 1st of 2006. That's when we launched the Global Macro Fund. It was prior to the global financial crisis. So these we're looking at all discretionary global macro funds that are still around today and that were around pre-global financial crisis. A lot of global macro funds didn't survive the global financial crisis in 2008, but these are the funds that have. And when you sort them by two different measures, so average annualized returns since inception, and by downside capture ratio. So we're looking at two dimensions. We want to, you know, the funds that would be in the northwest quadrant of this scatter plot, would be the ideal spot. The most protection in down markets and the highest overall absolute returns is what it's showing. And and here's for this is the downside capture versus the S&P 500 that we're showing now. And so you can see, our fund has had about the same overall annualized returns of the S&P 500 index, which is at record all-time highs and record valuations, and has had an enormous run-up since the global financial crisis. But it's, we've delivered about the same average annualized returns, but with a negative downside capture ratio. So we've also delivered that protection in down markets, and this is what a global macro fund is supposed to be. You can see that another prominent discretionary global macro fund, Bridgewater, their Pure Alpha Fund 2 and Pure Alpha Fund are also make this list for negative downside capture protection in down markets. And but Crescat has actually outperformed those Bridgewater funds on both measures: overall average annual returns net of fees and the negative downside capture. So, like we said in the prior slide, now I think is the time that investors should be looking for funds that have this type of a risk profile when the markets are at all-time highs. And so let's keep going here. We talked about how the precious metals fund just achieved its 5-year track record. So again, this is a non-correlated fund, non-correlated to the S&P 500, and it's one of the top performing industry or sector focused funds among all different sectors, but certainly among resource and mining type funds. And we just got our final numbers for July. It was estimates that we were reporting on earlier in the month, but now we have the final numbers, and they were actually a little bit better than what we had put out for our initial estimates across all of our funds, actually. And so these are the final numbers, and again, we've been outperforming the benchmarks here for the precious metals fund, and very excited about the opportunities still ahead for this industry. This is an industry that has gone through a 14-year bear market. Talking about the equity industry for mining stocks, and especially the exploration focused mining stocks where our portfolio is heavily tilted. So let's go on to the next. This is looking across all 5 of our hedge funds, the global macro, the institutional macro, which is our qualified purchaser version of our global macro fund, our long short fund, the precious metals fund, and the Crescat institutional commodity fund, which is again the qualified purchaser version of our precious metals fund. Both the Crescat Global Macro Fund and the Crescat Precious Metals Fund have reached their 100 U.S. investor limit, and so we had to open up these. These 2 institutional funds to be able to take on new clients. Otherwise, those funds are closed to new U.S. investors for all practical purposes because we don't have any more slots available. Is why we opened those funds, but they're very similar to the Global Macro and the Precious Metals Fund, that are 2 institutional funds. We have 5 of the top 10 performing hedge funds year to date in the whole Preqin database, and there's 1,300 funds almost that have now reported their performance year to date in the Preqin database for 2025 year to date performance, and we got 5 of the top 10. Past performance is no guarantee of future returns, but I do believe that we are early in the cycle for a number of our macro themes. We've talked about the short positions in the global macro and the long short funds, and how those funds have been able to be true hedge funds that actually short and have delivered that negative downside capture ratio. And then we have the precious metals and institutional commodity funds, which are more long only funds today. Those funds can short. There's nothing preventing us from shorting in those funds. We just choose to be long today and have been long focused since inception due to the ultra low valuations and the upside opportunity in that industry.